Hi, everyone. I'm Rick Bensignor. Today is Tuesday, March 7th. Welcome to this week's In the Know Trader show. On tap for today, our lesson of the week. Sometimes the best trade is not to trade at all. We'll talk about that. Before we get there, let's tell you what we have to offer you from In the Know Trader. We have a weekly tactical ETF report, generally comes out on Thursday evenings. What this report does is give you a very good background into the macro events and macro asset classes that affect the stock market. So we do a deep dive into the US Treasury bond market. We usually look at credit spreads. We'll take a look at the US dollar, gold, and a deep dive into the S&P so that you know which way I think the market's going, both short-term and medium-term, and the key levels to play off of. Then we provide you a new ETF trading idea each week, as well as go through, review, and update every open position that we have on the books until we close out prior trades. That comes out Thursdays. Again, you can get information from that at intheknowtrader.com to subscribe to it. I also have a monthly 7-Eleven report. That's what we call it. It is a report designed to outperform the S&P 500 by being in no more than 7 of the 11 macro spider ETFs at any given time. That comes out at the end of the month, where we reallocate for the new month across whether it's XLK, XLP, XLD, XLU, etc. There are 11 sectors, macro sectors to the market. Our goal is to pick the 7 that will perform best. And so far, we've done this very well. In 2022, we outperformed the S&P by 6.01%, while outperforming 11 of 12 months. In February, we outperformed by 11 basis points relative to what the spider did, but we still have a minor loss for the year because January was a tough year. In fact, our worst performing month of any month was in January, which is, of course, no surprise given the massive swings that we saw to start the year in the sector rotation. And since we started this report back in August 2020, we have outperformed by just over 10 full percent in its 31-month history. That's basically averages down to about 4% a year. That is huge in the money management industry. So few people even can come close to outperforming the S&P. We are outperforming by several percent on average per month. So again, you can find out about this at intheknowtrader.com. Get all the information you need to start a trial subscription. And then thirdly, I offer individual coaching services to both individual investors as well as people who are financial advisors. And they're kind of different type coaching sessions depending upon which one of those two you are. But for individual investors, we will spend the beginning of, let's say, our first hour together with me getting a sense of how you trade, what your process is, etc. And I will help you through coaching sessions to become a much better trader, help you refine your process, find out what's working, what's not working. And the key to success over time is something that is elusive to most people. We will get into that as we go through that process together. So that is available. Also, you can sign up for individual coaching sessions from our intheknowtrader.com website. Okay, so let's go back to this theme of the week. And as I said, it's really about understanding that being a good trader also is knowing when not to trade. And I bring this up specifically, it's Tuesday, March 7th, it's 10 o'clock in the morning, give or take. And I purposely brought this up now because this is the type week that we're going to get a lot of information that is macro type influence on the market, because Fed Chairman Powell is testifying in front of Congress both today and tomorrow, Tuesday and Wednesday, and easily what he says can push the market, which means that, for instance, yesterday, knowing that all this news is going to be coming out today and tomorrow, and then more so on Friday, we have the monthly unemployment report. And of course, with the Fed being so data dependent, this is going to affect next week's announcement on what the rate change is going to be. There's a lot of information here that's going to potentially push the markets higher or lower. And this is kind of macro stuff. This is not about any individual stock. This is not corporate news. This is the big picture stuff that you need to know. So this is the type of week, and again, a day like yesterday, Monday, where most investors, you can tell from the way the market trades, and you should know yourself, when you've got big news coming out like this, a day later, a couple days later, and so on, there's no reason to trade until you get a sense of what's really going on. And to put on new positions, whether long or short, as if you know which way and what Powell is going to say and what the employment report is going to be on Friday, is kind of silly. And this is the type of time when not trading is probably the best trade at all, because you have no edge when you trade now. Even if you have 3 different indicators line up and you say, okay, well, I've got several reasons to, let's just use for an example, to be a buyer of stock XYZ, unless you plan on getting out of it later that same day and being a day trader, there's virtually no reason to be putting on any substantial new positions. And some people love to trade all the time, and I get it. I used to be a floor trader. I mean, I traded, I can't imagine, 50 to 100 times a day, but that was a different role in a different time. And nowadays, dissemination of information and the way the whole market often moves together. Right now you've got the dollar moving inversely to stocks and yields moving inversely to stocks. And that kind of means that whether you trade the bond market, the foreign exchange market, or the US stock market, you're kind of doing the same thing. It's just looking at, which way it's going to go directionally or inverse directionally because of the other influences. There are times when it is just simply better not to trade, to put yourself in a position that you lose whatever edge, or you potentially lose whatever edge you have. And as I did a webinar a few weeks ago, you shouldn't be trading if you don't have an edge. And so if you think that, sitting at home, you're gonna, more than all the professionals on Wall Street, is not likely the best way to think about things. So you want to understand what the information is, see how the market interprets it. And of course, that means you're going to lag behind a little bit because the market's going to make some move, but at least get a sense of what's going on to properly position yourself for what the next likely move is going to be. And when I think about this too, in the context of all the news that's coming out this week and how much that can affect the direction of the market, don't forget that next week you get the CPI and the PPI numbers coming out. So, and again, all part of a data-dependent Fed, these are going to influence the Fed's decision next week. So even if we make a move this week based upon what we hear today and tomorrow from Fed Chair Powell, and then the big news that comes Friday with the unemployment report, that could all potentially get unwound next week, depending upon what CPI and a little lesser so PPI are. You've got to be on top of this if you're trading. And unless you're a very skilled day trader, and I don't suggest most people day trade, you have very little edge in day trading, despite what many people will advertise to you across social media. You have very little edge when you day trade and you're playing against supercomputers. You basically want to be swing trading to medium-term trading. several days to several, weeks, and sometimes it works out to a few months, but it's not the type thing where you want to be in and out, 3 times a day. Now, some of you can do that, but most people don't want to be stuck staring at their screens all day. So even with the news that comes out this week, next week is also a big week for news, and of course the rate hike coming next week, and nobody can anticipate with high accuracy what's that going to be. In fact, just even this morning, we're hearing that Fed fund futures are now priced higher than they've been on this whole move. I think they're priced as high as 5.6%, somewhat late in the year, and maybe 5.44 or so for year end is what I heard a few minutes ago. So rates keep going up. We're kind of in this higher for longer type of cycle. The Fed chair keeps telling us that that's what the story is, and there are those who just refuse to listen to one of the most powerful men, essentially, in the world as far as the economy of the United States, and therefore that trickles to economies almost everywhere else. If the Fed is telling us higher for longer, why everybody wants to disagree, not everybody, why so many people want to disagree with that and think that the market's going to shoot straight higher is beyond me. So anyway, the lesson of the week, and this is all we're going to talk about. We're not going to do any charts right now. In fact, more and more, I'm concentrating on lessons for the week and just keeping it to that. Is again, think about this and keep it in the forefront of your mind on a consistent basis. Sometimes your best trade is not to trade at all. I hope you get some value out of this. I'm Rick Benson. Thanks for watching In the Know Trader. Have a good week.